Welcome to the NDIS Property Australia podcast. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Good afternoon. Welcome to another podcast at NDIS Property Australia. My name is Minh, and I'm here with a special guest speaker, Greg Huxley from the Sunrise Foundation. And today we're talking about one contract properties setups for SMSF buyers for the NDIS. Greg, welcome today. Welcome along to our podcast. Please explain who you are and what you guys do at Sunrise. Yeah.
Thanks, Minh. I'm one of the founders of Sunrise Foundation Limited. Sunrise Foundation was set up to address the problem of crisis housing, affordable housing and social support housing. And through that, it also moved into the NDIS housing space. Sunrise's model is built around a commercially sustainable model. That is, it's less reliant upon donations and founder support, but more using the expertise of the board and advisors to the board who give of their time to develop commercial and residential real estate, where the profit from that and part of the property itself fulfills its constitutional objectives, and that is to support all forms of social and crisis housing.
Wonderful. So you've already started helping us out with some of our clients for SMSF, whereby first of all, can you explain to our listeners why is it too difficult to do two-part contracts with SMSF, please?
Yeah, well, one of the problems we addressed is that constitutionally we want to support an area that's still very underserviced, which is the NDIS housing. NDIS housing investment by its very nature is very long-term because it's cash flow return strong, but in terms of capital growth, it doesn't perhaps have the capital growth expectation that other forms of real estate might have. So the logical investor for NDIS housing, for example, is either charities who literally just purchase the real estate and hold it for the long term, relying upon benefactors, or alternatively self-managed super funds that are looking to use the tax concessions that are available to self-managed super funds and build a long-term portfolio. Now, part of the problem with that, Minh, as you've just touched on, is that self-managed super funds, as a matter of law, can't enter into multiple contracting. That they can't, for example, become a developer. They can't purchase land and then enter into a building contract. And that's where Sunrise Foundation saw an opportunity, because its constitution empowers it to do whatever it can do to encourage and to enable development of housing in that sector. So what it does is it uses its charitable status to identify land, identify builders with support, for example, of your company, Minh, and put together a package. Now, it's doing that to either retain that package with funding support from one of Australia's leading wholesale funders, or in other instances where it can't afford to hold it, sell it to for example, to a self-managed super fund investor who is then able to enter into one contract. So they can come to us and say, right, we are looking for a completed project, and Sunrise Foundation can do it with funding support, the expertise of its directors, put the package together and deliver it on a cost-effective basis to a self-managed super fund investor.
Wonderful. Is this a costly exercise for the SMSF?
Look, not really, Ming, because if you take a typical timeline, and because of the general state of the economy and the pressures that are on the construction industry for a moment, at the moment, building costs and timelines have all blown out. So Sunrise Foundation, because of the support it gets from one of Australia's leading wholesale financiers, accesses very cheap money. It purchases the land, it builds, so it pays those interest costs, it pays the various imposts associated with purchasing land, engaging valuers, arranging finance, servicing interest, and then at the end of the transaction is able to pass it through. It reclaims those costs, adds a relatively small margin, which in effect is the profit return that the charity generates, which it can then use for its charitable works. From the investor's point of view, if they tote up all the costs, leaving aside the legal difficulty or in fact the impossibility that a self-managed super fund has in doing it, but to go and buy the block of land, pay all the costs associated with finance, valuation costs, progress claim, inspections, quantity surveyors, etc. There's really not much cost difference at the end of the day. They get handed a completed product, all costs paid, legally compliant with the rules that apply to self-managed super funds.
Gotcha. And I assume that an SMSF loan traditionally would look like a 80% LVR in the marketplace, and the same would apply to this scenario with your SMSF one-part contract as well. Is that correct?
Yeah, well, that's correct. But Ming, you'd know, and your company is very active in this space, there's not a lot of quality bank lenders that will go to that level of exposure. This is one of the dilemmas facing self-managed superannuation funds, is that a lot of the major lenders are still coming to grips with the basis that they value these assets. They failed to take into account the level of return that you get from this type of property investment. And for example, a typical problem that we've needed to deal with is you have a 3-bedroom SDA compliant NDIS style house in the same street as a standard residential home. Yep. There's a lot more investment and construction cost goes into the SDA approved home, but it's reflected in a rate of return that can sit anywhere between 10 and 12, 13%, whereas a residence in the same street might be 3 or 4%. So we've had to work hard with funders, and we do achieve an 80% or better loan to value ratio without the imposts of LMI and some of those other costs.
Yep. Yeah, I think I've seen the last year or 2 years other lenders out there with 80% maximum or 70% or 60% or even 50% LVRs as their standard for SMSF lending. So I think we think it's wonderful that your company with this wholesale funder can deliver an 80% LVR product for an SMSF based on valuations, based on commercial calculations.
Yeah, well, what it means is that a cautiously managed, self-managed super fund portfolio, by committing less cash to one particular investment, can establish a geographic spread. So you don't have to isolate yourself, for example, to one investment in one area. Some areas perform a little better than others, and even longer term. No one's got a crystal ball. So by borrowing, for example, 80%, and you've got a good margin between your cost of funds and your likely return, rather than buying one with a 60% LVR and committing all of your cash to one property. You can buy two properties, gear them to 80%. You've got a good spread. You're increasing your income earn, establishing geographic spread, and that gives you a safety margin into the future.
Is there any benefit in providing a bigger deposit to make it a 60% LVR with this wholesale funder you refer to?
No, because they're not penalised with LMI, which is the normal buffer that, for example, a traditional bank might apply. The particular funder that we work in conjunction with have embraced a commercial valuation model. So the valuers are taking a more realistic position. They're looking less at the value of the bricks and mortar and more at the sustainable cash flow, which, when all said and done, is underwritten by the federal government. It has CPI built in. It's very hard to come up with a safer income stream in terms of real estate investment.
Gotcha. For the benefit of explaining to our listeners, what does a wholesale funder mean?
A wholesale funder is traditionally one who, for example, brings in funds from, say, overseas banks, may even have warehouse funds with the Australian banks. It manages the money and places it with retail outlets. In the last 10 years, 15 years, perhaps even a little more, a lot of brands have popped up who put together residential loans and investment loans. And a lot of the names out there wouldn't be known to people. Every time you look, there seems to be a new lender pop up. But those people do the retail end of lending. They take the loan application and they process it and they do the credit checks and they package it up and they put it together. And a wholesale funder then provides the money. And all they do is they provide a block of money to that retail outlet at a rate. The retail outlet adds a margin to it. That margin usually equates to risk. Risk takes into account LVR, whether it's 80% or 90% or 95%. They sometimes have to cost in LMI. We've got the benefit of being able to deal directly with the wholesale funder in terms of the foundation's financing. That puts us at one less layer of overhead. As part of the work that we do, and as part of de-risking our transaction, we negotiate separately the best finance we can get for the end buyer through one of the retail outlets, but associated with the wholesale funder. Gotcha. And that then means we're taking on the debt and the responsibility of putting together the package, building the property, making an election whether we're going to keep it within the foundation's portfolio. But if circumstances are such, we sell it to a self-managed super fund and de-risk the transaction ourselves. We have them approved at really the best rate that would be available. And we've got some that have been done at 90%. Now, of course, that's a quality fund with good asset and support and quality guarantors. But that enables them to take on some more property in that area, increasing the income and spreading the geographic risk.
Yeah. I think you emailed us recently showing the article from choice.com.au showing other SMSF loan products in the marketplace. And those interest rates compared to what you're offering from a wholesale funder's point of view, your rates were even cheaper than those. So it's a better product and a cheaper product.
Yeah, look, we've been very lucky there. We managed, because of other work that the foundation was doing in the crisis housing area, we met up with a major funder who was looking to give support in the charitable space. And the relationship really built from there. And by, again, being able to tap in to wholesale rates and even their retail rate for investors who do take one of the properties from the foundation tend to be under market. But the main benefit is a higher LVR, and that's come about coupled with a more intelligent approach to the valuation challenge. And slowly they're changing, they're acknowledging, as in commercial real estate, Ming, we've actually talked about this ourselves. We were discussing shopping centres, for example. A shopping centre is not valued as a pile of bricks on a block of land. They take, for example, a lease from a major retailer, such as Woolworths, and they say, well, here's $1 million a year coming in on a 20-year lease. We'll capitalise that at 3 or 4%. That building is worth 20 to 30 million. But as a block of dirt with a pile of bricks on it, it wouldn't be worth anything like 20 million. It's worth 20 million because of the income stream. These NDIS, SDA approved properties, their value is that income stream because it's a long-term government supported income stream with CPI. It's hard to come up with a better income mix for a piece of real estate. And the other benefit of that, which we've not talked about, is that not only is a family building their own wealth and providing for their own future, they're actually helping people now who need support and help.
Exactly.
The recent budget has acknowledged that. It appears that the Labor opposition at this stage is fully supportive of those initiatives. So it's a sector that's going to continue to get regulatory and federal government funding and support. So this is an opportunity for investors to invest in their own future and their own families and do some good at the same time to meet the enormous shortage of housing in that sector.
Yeah. I remember a year and a half ago, the government had a few years ago, the federal government had a $22 billion budget per year moving forwards. And then 6 months ago, it became $30 billion a year for the next 3 years. And now, as of the budget's just
come down. They've announced 40 odd billion.
40 billion.
In fact, it's approaching, I think, the total budget for Medicare, which I think was something like 50 odd billion.
So I think if you look at the news, you'll say 157 billion for the next 4 years, which is basically 40 billion a year for the next 4 years, which is almost double what the plan was originally. I think Medicare is 50 billion a year, and NDIS is now looking at 40 billion a year. And no doubt it will increase by 10% per year.
Well, they've allowed a 9-point-something% increase annually. And but even with that, when you look at the numbers and break the numbers down of the waiting lists and the people who are looking for housing support, I think we were talking today in Victoria, for example, they haven't accommodated for 10% of the waiting list at the moment. So there's a crying need for the property. It's got government support. The government is acknowledging the need by paying a much higher rate of return upon the property than you can get from a traditional real estate. So the challenge for the self-managed super fund was to find a bona fide way of participating in the market. And it's brought around by the fact that if you wait for the properties to be developed and available, they're snapped up before that. That appears to be what's happening in the marketplace.
I guess over the last year or so, there's been a lot of talk in the press about the sustainability of the NDIS. And now with the government coming out with the budget saying we're going to double it to 40 billion, that just affirms the commitment behind the NDIS.
Well, the tragic reality of it is that something in the order of 18% of Australians suffer some form of disability. Now, that might be a mental health issue, it might be a physical impairment. That number's not going to decrease. And what people have realised finally is not providing proper support makes their lives even tougher and the challenges a lot tougher. So Australia's always been regarded as a society of giving everyone a fair go. Governments have acknowledged that. And what there is in the funding is a lot of catch-up. But there's a lack of infrastructure and infrastructure down to housing product. And the NDIS housing product, for example, has features within it which cost a little more to include, wider doorways, for example, and the things that you would need for wheelchair access, as an example. And that's acknowledged in these budgets. So you've got an enormous group of people who require this specialised help. The government is acknowledging it. Their budgets are to increase it and not to restrict it. And superannuation fund laws, as an example, encourage longer term investment. So even in what we'd have to regard at the moment as a time of uncertain interest rates, any cautious investor would stress test their interest rates. But if you're borrowing in the 2.8 range as example,
2.8%, right?
Percent per annum. Let's say that you just conservatively double that rate, and I don't think there's too many people out in the marketplace saying it'll double, but if you doubled it and made it 5.6%, you've still got a very healthy margin between that and the rental return from this sector of property. We
always explain to our clients to expect an 8 to 12% net return for NDIS as a generic snapshot. Right. And if you're right, if it's 5% interest costs and the net return is 10%, you're still ahead of the cost.
Oh, absolutely, absolutely.
So we've gone off on a tangent to the federal budget. So let's pull it back to SMSF, right? Yeah. So, Greg, if a client wants to consider the Sunrise Foundation process of doing one-part contracts, what is the process for them to engage your organisation?
Well, it comes through you and your company as example, Ming, because we're not a marketing organisation. We're first and foremost a charity.
Yes.
We've got a pipeline of crisis housing projects ranging from residential home units in the CBD in Sydney. We're negotiating with a major developer for residential home units in the CBD in Melbourne. We've targeted some low-entry, low-value retirement village assets to target older people in crisis, in income crisis, so with no capital, for example. In the NDIS space, we've got options and securing sites ourselves to provide both affordable housing with a mix of SDA property.
But if a client says to us, our company,
certainly. Well, through that, we can then assist there because it fits within our constitution. Okay. We say to somebody, look, we agree this area has a need. We've got a capacity to do some. You want to buy a property in there. We're going to go and buy that property. We're going to develop it. And as we go through that process, if you then want to contract to buy that as a completed product for it to be used as an NDIS property, which is consistent with our constitutional objectives, we will facilitate that. And it enables them to use their superannuation fund to enter into a single contract to take delivery of a completed product.
Sure. So assuming an SMSF client has an SMSF set up with their funds in their account, they can talk to your organisation about doing a fact find, filling out a fact find to assess yourself, to give to the wholesale funder to assess as well. If they say, should look okay, and you assess it, then really it's a matter of just ticking the boxes, and those boxes are.
Well, we go ahead then and purchase the property.
Yep.
And then because we assess that risk, and we have in the back of our minds, we may well, in that particular case, finish up owning that property.
Yes.
But the election is that the superannuation fund could say, no, we're going to go ahead with that. They've got in effect, a pre-approval on the investment.
Yep.
And they commit on that basis, and we commit on that basis.
Yeah. In one of our last podcast series, we talked about the rough costs an investor or an SMSF investor should have ready to consider for a one-part contract, SMSF or NDIS. And we thought about probably 30-35% is the range they should have of the purchase price. Can you confirm that is a rough, good guide of a number?
Yeah, look, the final number that we've found, that we come in at less than that it seems to play out at about 25%. So if you go in there with that expectation, if you're looking at a package at around the $800,000 to $900,000 range, and you've got between $250,000 and $300,000. That's the right sort of margin to have. And then as things get closer to completion, as I said, we've done an SMS facility at 90% of valuation. It was a quality fund, good income streams, there were good contributions going into it. But the other thing to bear in mind is once your nominated consultants, the providers, have lined up the participants, and it starts off with, in effect, a comfort letter. You're asking people to commit to move in and rent the property. It could be a year before it's going to be ready. So, you get a firm commitment. But as that firms up, both from the investor's point of view and the funder's point of view, the state of the fund matters less because the income stream is confirmed and it is so solid.
Yes.
You were talking there before about citing examples of 8 to 10 to 12%, but as you know, they start off in the 10, 12s, up as high as 15% on some of these properties.
Yes.
Now, when you lock those participants in, which you do as you get closer to completion, because people on waiting lists say, hey, that house is within 6 weeks of being ready, I'm going to commit, I want to change my life, I want to stay within the community where I've lived, this is perfect for me. You lock those participants in, go back to the financier and say, well, here's my cash flow, because at the end of the day, what the funder's concerned with, so obviously they want to know there's value there.
Yes.
Obviously, because that protects their capital, but the ability to service. And the self-managed super fund has that income stream locked in. They know it's it's federal government supported. They know it's annual CPI. That's when you can start to improve those percentages and drop their commitment back even more.
Yes. Cool. And I think you've done a handful of these NDIS transactions with clients already, both SMSF and non-SMSF clients. How have you seen the valuations becoming at?
Well, through one of the contributors to the charity, we've assisted some persons who have not been self-managed super funds, who just want to buy them as an investment. We've only had, in fact, we've got 12 in total so far, and we've only been in this market since just before Christmas. We've had one instance in a North Queensland regional area which came in a little undervaluation, and that was a valuer that was just called in pretty much by the funder at the last minute, because the normal valuer, the larger valuation firm, in fact, was just too busy to get there, and there was some pressure on to get settlement done, and it was valued on just a straight up normal residential basis, comparing a 3-bedroom house to a 3-bedroom house. It was subsequently revalued at the full price.
Oh, wonderful.
So the valuation has traditionally been a challenge, but people are now seeing this as a sector that's got real legs. It's got federal government support, solid income stream, demand, and they're taking a commercial basis to the valuation process.
Yeah, we've done a few of them already, and I think that only a handful coming at 40 or 50 grand short. So which is reasonable.
Yeah, but you'll have that with
in a normal house anyway, yes.
A unit in a home building. In a home unit building, I mean, it's not uncommon for that to be the case. But the biggest challenge has been valuers looking at it as from the investor point of view, leaving aside the fact that we're talking about social housing, we're talking about people's lives, and we're talking about what we're all doing. At all levels, people are making money out of this. The charity makes money out of it. That money then just goes into its own charitable works and its own property development.
Yes.
But so there's that profit side to it. But we shouldn't lose sight of the fact that there's a social need. And a lot of the people that are investing, and I've seen this, a lot of the superannuation funds that are investing in it, their initial interest is, well, I want to do some good.
Yeah.
And then when they get into that space and they start looking at the numbers, they also see, well, hey, this is a win-win for everybody.
Yeah.
It's a win for the society.
It's a win for their investment and their super fund. A typical age bracket seems to be sort of late 30s, 40s, early 50s. These people have got anywhere from sort of 20 to 15 years sort of to go. They're accumulating on the most tax-effective basis, substantial positive cash flow. It's the perfect investment to provide for the retirement for yourself and your family.
Yeah. I think people realise that if they're getting an investment like this at 13 to 50% gross income and getting a net of 10% net income now, with CPI over the next 10 years, that will become 14, 15, 16%, 16% net income long term, because the CPI increases the income every year as well. Yeah.
Well, I haven't done any modelling on that, but money at 10% doubles every 7 years. I suppose we could work back to they're talking about inflation when we first started talking Christmas time, Ming, about some of this. Now the government in the budget was predicting CPI of 3.75.
Yeah.
So,
and that will reflect in income as well.
Absolutely. Well, it just flows through, and this is automatic. You don't have to go to a tribunal and fight with the government. This is mandated. This is how their leases work. So you've got this ratcheting clause. The rents go up; they don't come back, and there will be solid demand just because of the sheer numbers.
Yeah. So, in a nutshell, I think we've covered a lot in the last 30 minutes about how Sunrise does help with SMSF one-part contracts. We talked about how the government is really behind the NDIS now, the NDIA, sorry, and then also valuations and SDA products in its own right. So, are there any final pieces of advice you have, Greg, for wannabe SMSF investors or even normal investors for SDA?
Oh, well, no, Ming, I think we've covered it all. As I said, I think from the Foundation's point of view, its driver is to fulfil its charitable objectives. It's able to facilitate increasing the availability of property by helping a sector of investors who otherwise couldn't participate in it. And the budget was going to be a little bit of a determinant maybe as to what might happen. The country's carrying a lot of debt, so if there was ever going to be a reduction in expenditure, you'd expect to see it now. But in fact, it was a substantial increase, given that the NDIS was originally a Labor initiative, and I'm not a political pollster or tipster, but there's probably a reasonable chance of a change of government. But it doesn't matter whether it's Liberal or Labor. No one's going to reduce those numbers, not in the foreseeable future. So it's a sector that we're actively involved in. We'd encourage people to look at it. And thank you for the opportunity, Ming, of running through this afternoon.
Wonderful. Thank you so much, Greg. And to all our listeners, there'll be further links below to the federal budget and also, top direction to Sunrise as well. And we'll look forward to helping everyone else from there. Thank you very much. Bye-bye.
We hope you enjoyed this episode. Please make sure that you are subscribed and following us so that you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this episode with those that can benefit. Until next time, catch you on the next episode.